Hello, and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we've been discussing here at Quilter Cheviot. Remember, so you don't miss future episodes, do be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comments on LinkedIn. I'm Oli Creasey, Property Research Analyst in London, and this week we're joined as usual by podcast stalwart and Head of Fixed Interest Research here at QC, Richard, and of course, the less regular but no less valuable Will Howlett, our financials analyst. Good morning, gents. Richard, we'll come to you first as always. I was thinking about this the other day, and I can't honestly remember the last podcast we had where inflation wasn't discussed first up. I'm guessing it's probably over 2 years ago, but I don't know if you have a view on that. Our rotating group of hosts, you've probably noticed, running out of new ways to bring it into the conversation. So I thought I'd just be direct about it and admit that and try a slightly new approach. So inflation seems now to be settling into the sort of low 3% region here in the UK. How long do you think it'll be until that's just accepted and it's no longer the hot topic of the day or maybe year?
Ollie, I had noticed that I was asked about inflation quite a lot, and I think you've hit the nail on the head. To be quite honest with you, it would always be an important topic because of what it means for central banks and all the rest of it, and interest rates. But I actually think it's starting to wane as a concern at the moment in some ways. I mean, like I said, inflation in the UK is coming down back towards target. It should be back within the 2 to 3% range fairly soon, and yes, it's a bit sticky in the US, but it's nowhere near as bad as it was. So it is starting to ease off, and I think there are other focuses like the elections this year, and also I think, to be honest, geopolitics is now becoming the main, almost the main topic at the moment with Iran and Israel, everything going on there, as well as Ukraine and Russia, and also I think sort of the potential for increased tensions between China and the US, as the year goes on towards the US election. So I think inflation as a topic, will still be very important. It will ease off a little bit in terms of its importance. Although, of course, when we analyse geopolitics and we talk about Iran and Israel, one of the things that people watch a lot is what that means potentially for the oil price, because obviously if the oil price goes back up again, we're right back where we started with another rise in inflation. So yeah, it's still there, but I think there are other topics sort of creeping up the agenda.
Yeah, thank you, Richard. As well as the UK inflation conversation, we also got some reports on UK wages and also retail sales last week. I take a little look at these, but I'm curious how closely you follow them and whether you find them useful indicators for economic progress and maybe even future inflation figures. And assuming you do, what can we take away from those data points?
Yeah, I definitely do watch them. Doing bonds and fixed interest, you've got to keep a close eye on these sorts of things. Although I think it's important not to look at just one individual number, but consider the whole. And I think when you look at the UK, yes, wages are quite sticky, but the unemployment rate is rising a little bit. Inflation's coming down. Retail sales are fairly soft. The economy is doing okay, but nothing special. And I think that really all points to the fact that the Bank of England could be in a position to cut interest rates fairly soon, potentially as early as June. And the kind of narrative's been, well, US is very strong and sticky inflation and rate cuts expectations being pushed back. Actually, I think in the UK and Europe, there's scope for them to be cutting interest rates from the middle of this year. And I think that the latest data really is still pointing in that direction.
Now, I'm about to say something that is probably going to come back to haunt me. But looking through the lists that we get, this week looks like it's going to be a fairly quiet one, at least from an economic perspective. I can see a US GDP announcement and jobless claims as well. But apart from that, what else are you keeping your eye on? And I suppose what else might we expect from those announcements as well?
Yeah, that's right, Ollie. What we certainly won't hear this week actually is anything from Fed officials, because they're in their quiet period before their next meeting, which is on the 1st of May. And you're right, it is a little bit quiet on the economic front potentially, but I think what the numbers we will get out will confirm is that the US economy is still pretty resilient. GDP growth is still pretty strong. Labour market's pretty tight, and it's still too early for the Fed to be cutting interest rates at this stage. And actually, we've seen last week that those sort of expectations for cuts keep getting pushed back, and the market's now only pricing in about 40 basis points of cuts by the end of this year, which is quite a big change from where we were at the beginning of 2024. And as I say, I think that the data we get this week will probably confirm that it's too early for the Fed to be cutting rates.
Great, thanks, Richard. Final question, maybe a little unusual. We do like to sneak a bit of politics in here and there. That political landscape is continuing to evolve. You kind of mentioned geopolitics and so on earlier on. We've got UK local elections coming up next week. We've got the ongoing Indian elections. We've got Donald Trump's jury trial in New York. Probably a few other things that I've forgotten as well. But I'm curious, are these things that you're keeping a close watch on, or do you think they're a bit of a sideshow?
I keep a close eye on them because I'm interested in politics. But to be quite honest, I don't think the share price of US tech or the 10-year US interest Treasury yield will be affected by a lot of this. Certainly in the short term. I mean, UK elections, we know that we're some way off before the general election. Indian elections, fascinating kind of massive exercise in democracy that takes weeks, but Modi is expected to come out triumphant at the end of it. I think the big thing still this year is the US elections in November. I think there's going to be quite a bit of China bashing going on, potentially from both sides, and I think you're starting to see this. People looking at China, Russia, Iran, North Korea as kind of one block, and then you've got the US and Europe, a few others on the other hand. And I think that sort of geopolitical risk is really going to come into sharp focus in a US election year. But I think as I say, for now, I think the sort of UK stuff and the rest of it will be a bit of a sideshow.
Thanks, Richard. Now, Will, if I could turn to you, please. I thought you might like to discuss some of the companies that we are invested in, and I suppose some of the ones that we're not as well. I think we're about midway through the Q1 earnings season now, but I did notice that last week was a particularly busy period for you. It seems like loads of financial services companies in the US have published trading statements and similar in the last week or so, and everyone from JP Morgan to American Express getting in on that act. Would you be able to summarize the week for us at all? What we've learned, who've been the winners and losers in your opinion, perhaps?
Yeah, we've had the biggest US banks reporting over the last week or so. I think a lot of focus where banks are guiding to on net interest income, given the uncertainty about where interest rates are heading. And as Richard has mentioned, the market has been reining in expectations of cuts since the start of the year. I think in theory, this should be positive for banks as long as economies hold up, and they are doing for the moment. So, higher for longer interest rates being a better environment for them to earn spread income. So that's the rate that they make on loans, less that the rate that they pay on deposits. So a higher interest rate environment, is better for that spread income, and most clearly seen, I suppose, through non-interest bearing liabilities. So think of things like your current accounts for consumers or businesses. They're effectively funding at zero interest rates, which banks can then lend out or invest, in a higher rate environment. So non-interest bearing accounts, for example, make up just under 30% of deposits at JP Morgan, and a higher share at Bank of America, for example, a couple of the stocks that we're invested in. But I suppose there are concerns, if rates stay higher for longer, more of those zero or lower rate deposits are going to continue to look for higher rates. And certainly that was the theme last year, which led to most banks actually seeing a squeeze on net interest income. I think there's also a bit of disagreement now in terms of how long does that deposit shifting continue. So some banks were saying it's mostly done, whereas others, for example, JP Morgan's CFO, expected it to continue. And that was one factor that meant that JP Morgan didn't raise their net interest income guidance for this year, despite rate cuts being moved out. I think it's completely understandable given It's still early in the year and expectations around rates have moved around so much. In terms of some other themes, you really saw investment banking having a better quarter as markets rallied, and you saw deal flow returning as well. So more ECM deals, more DCM deals. And then if we look at loan losses, the consumer seems to be holding up pretty well. We did see some building of reserves in credit cards. So that's one area to look at, but I think consumer generally okay. On the commercial side, it's really all been the focus on commercial real estate and particularly office, in a higher rate environment and with people working from home, that's really been headwinds for commercial real estate office. And if we are in a higher for longer interest rate environment, that's more of a headwind because those loans have to be refinanced at a higher rate. But I would highlight that, this is much more of an issue for the smaller regional banks versus the biggest banks in the US where we look at. So office loans, for example, are just a low single digit percentage of total loans. So, not really moving the needle for the biggest banks. So those are a few of the themes. In terms of winners, I would point again to JP Morgan, even if the shares sold off on the day of results because they didn't update on the net interest income. The bank, really posted strong numbers again. So the market looks at return on tangible equity, which is a measure of profitability, and they delivered 21%. So a very strong number versus peers. And again, it really reflects their market leadership across a number of areas, across retail, commercial, investment banking, and those economies of scale, as well as diversification in earnings, mean they can generate very strong numbers across the cycle. Yeah, American Express also had a good set of earnings. This was really more driven by net interest income. So effectively people, spending more on their credit cards and not paying it off, which does carry a bit of a risk of loan losses going forward. So it was that which seemed to drive things rather than the fee income from people spending on their cards. So, quality of the beat, not so good maybe, but good set of numbers. In terms of losers, a bit generic, but I'd still be cautious on some of those regional banks given the squeeze on net interest income and the higher exposure to commercial real estate as well. So would prefer the biggest US banks against the regional names, for example.
Very good. Thank you for that. I've also noticed that we've actually got the European banks mostly coming up this week. So it's their turn now. What should we be looking out for here? And I suppose, what are you looking out for?
Yeah, so we've got some of the UK banks reporting this week. I think, again, analysts are going to be looking on those guides for net interest income. So no surprises there, I'm afraid, in that higher for longer environment. I think really, again, what drives that guide is going to be how the deposit shifting issue has been moving around. So depositors are looking for higher rates, for example, and squeezing margins. So certainly that's going to be in focus for all the European banks. We did have a couple of banks in Europe reporting last week, most notably for us, Nordea, which is the largest bank in the Nordics. I think the results were absolutely fine. There was a little bit of disappointment that there was no update on their buyback plans. The market is really focused here, given there's some very attractive distribution yields available in European banks. So that's just adding the dividend yield and the buyback yield. So I think that's, again, capital return is going to be something the market will be focusing on. So, for example, we will have ING, the Dutch bank, which should update on their buyback plans at the first quarter. And I expect that to be hopefully received quite well by the market.
Great, thank you very much. A final question for you now. During some of our recent conversations around the desk, you've highlighted the divergence between the US and the European banks in terms of valuation metrics. Is it as simple as saying that EU financials are cheaper than their US counterparts, or is it a bit more complicated than that?
Yeah, that discount has been there basically forever, albeit there have been times where valuations have been relatively close, and I'm looking here at forward P multiples for simplicity. I think that generally has made sense given the stronger economic growth that you see in the US relative to Europe, for example. And you can think of banks as leveraged plays on their respective economies. So it makes sense that the US names would trade at higher multiples. And reflecting that, we are likely to see the ECB cut ahead of the Fed. And so that's going to weigh a bit on the outlook for net interest income. But that valuation discount has widened, and I think that's more difficult to justify. So European banks are actually generating stronger profitability over the last 12 months, and that's just measured by return on equity. So remember, the European banks also have a higher interest rate environment, and post the Eurozone crisis, it's just a complete contrast because, post the Eurozone crisis, banks were dealing with negative deposit rates at the ECB. So that just made it an incredibly difficult time to make a decent spread. I think the other thing to highlight is that capital return as well. So banks generating a kind of 11% distribution yield at the sector level. So that's that 7% dividend yield and adding on a 4% buyback yield as well. So, attractive levels of capital return. That European banks trading at a discount, but I think the scale of that discount is just pretty difficult to argue for at the moment. It's about 40% at the moment on forward PE. I think 7 times plays about 11, 12 times for the US banks in terms of forward PE. So, that valuation discount, along with the higher for longer interest rate theme, resilient economies have meant that European banks have been outperforming over the last few years.
Great. Thanks, Will. And indeed, let me say now thank you to both Richard and Will again. Some really useful insights there. And of course, thank you to all of our listeners out there for listening and joining in. We hope you've enjoyed today's discussion, and we do genuinely love to hear from our listeners. So do give the show a review now wherever you're listening. Do, of course, share it on those various social media sites, and please tag us at Quilter Cheviot. And again, just to make sure you don't miss any future episodes, do hit that subscribe button. We'll be back next week as always. And in the meantime, do please head over to the website. That's quiltercheviot.com, where you can, of course, read the accompanying market overview here, as well as subscribe to the weekly comment and other very high quality newsletters. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on that website, or again on our social media pages. That's it for today. One more thank you to our guests and hosts, Richard and Will, for your time. Thank you all for tuning in, and we will see you next time. Bye for now.